Okay, we're going to have a look at marginal costing, and we're going to start with an ordinary level question from the 2018 ordinary level exam paper, question 8. Um, we're going to learn a lot of the basics and some definitions here on marginal costing by doing an ordinary level question, and then we'll be able to translate and use some of those as we go on to a higher level question afterwards. So let's have a look at the shape of the question first off. It says Shefflin Limited manufactures a single product. Let's take baseball caps as an example. And the following is the proposed annual budget for the coming year. So they're planning to sell 44,000 units and they're going to make 880,000 euro from those sales. Their variable costs and their fixed costs are listed here, and you subtract those costs away and you're going to get the net profit. Now, in marginal costing, it is really important that we understand the difference between variable and fixed costs. Variable costs are those costs which change as production levels change. So as you make more caps, you will have more of these costs. An example might be materials. As you make more caps, you'll need more fabric. Wages will be a variable cost. As you make more caps, you'll need to pay more wages. Maybe even electricity is a variable cost. As you make more caps, you'll have to use more electricity. Whereas the 141,500 here, the fixed costs, those are costs you have to pay irrespective of how much production you achieve. So therefore, it doesn't matter whether you make 40,000 caps or whether you make 4,000 caps, you're still going to have to pay your rent, you're still going to have to pay your insurance, you're still going to have to pay your rates. These would all be considered fixed costs, and they are a fixed amount regardless of production levels. You take away both of those costs anyway to get your net profit of 298,500. I'm going to explain a little bit more about that when we get into the answer. You're asked to calculate part A, B, C, D, E, and F here, and then there's a theory part in part G. In the answer, I'm going to actually put in another little calculation, something which is not asked in the 2018 question, but is regularly asked in ordinary level and higher level questions. So therefore, I want to teach it in this video, so we'll add in an extra bit. But we're going to take this information here now that we've been given from Shefflin Limited, and we're going to translate it into the solution. So we're going to flick to the solution here now. And this is what we call a marginal costing statement. Now, this marginal costing statement is the basic way that we will always set out a marginal costing question, higher level or ordinary level. What you're going to do is you're going to write down your sales, take away variable costs to give you your contribution, take away fixed costs to give you your profit. Now, the profit here, of course, that 298,500 is exactly the same as the profit in the question, 298,500. You know, it's the same process. Here we've taken away these two items as well. It's just that we do have an interim number called contribution, which is a new term for us. And I'm going to explain that as we go down through the question. But first off, let's look at this. So 44,000 baseball caps we sell. We have sales of 880,000 according to the question. If you take away the variable cost first, you're left with your contribution, which is 440,000, the other half, basically. And then if you take away your fixed costs, you are left with the profit for the year, which is 298,500. Now, the more relevant column here really is the per unit column. So this is the total for 44,000 caps. But for each individual cap, how do I get this? Well, I take these numbers, these total numbers, and if you divide by 44,000 caps, you'll find out that we actually sell each cap for 20 euro. Now, the variable cost of making each cap, the fabric, the wages, the electricity, maybe the logo, branding, royalties, things like that, they total to 10 euro. Which means that for every cap, when you take off that, there is a contribution of 10 euro. And that contribution goes towards covering your fixed costs. That 10 euro, each cap contributes 10 euro towards paying your rent and your rates and your insurance. And then when those things are covered, it contributes to your profit. So that €10 is the reason it's called contribution is because it contributes to covering your fixed costs initially, and then when you have sold enough of them, it contributes to your profit. Those are important definitions and important distinctions for all marginal costing, not just ordinary level. This ordinary level question is quite simplistic. Actually, the first three parts, look what it says. It says calculate the selling price per unit. We've just done that. That's part A, €20. Calculate the variable cost per unit, €10. Calculate the contribution per unit, €10. So, we've done all the work really. For part A, B, and C already by doing our marginal costing statement. So we're on to part D of the question, where it says calculate the break-even point in the volume of sale and sale euro. Now, what is it to cover all of your fixed costs, but not yet achieve a profit? So therefore, the amount of units where you are not yet making a profit, but you are covering all of your costs, essentially where your profit is zero. And that, of course, is where you're breaking even. That's where the business comes from. Now, we know that at a point of 44,000 units, so therefore common sense will tell us that the break-even point must be somewhere below 44,000 units. But there's actually a formula to work this out. I'm going to bring this down here and I'm going to show you this formula. The contribution per unit. Fixed costs are 141,500. If you divide in the €10 from each cap, which contributes towards covering that, that means that your break-even point is actually that means that the first 14,150 caps just go towards covering your fixed cost, and then 14,151, that first cap, after your break-even point is a profitable cap. So you break even at this level. Now that's revenue, so we know that we sell each one by €20. So if you multiply that by 20 euro, which again we of production, the break-even point is actually 14,150. And sales value, if budgeted sales for the period would be 30,000 units. So they're changing it a little bit here. They're saying, what if you just made 30,000? How safe would you be? Well, it doesn't really matter what level of production. The margin of safety is your sales take away your break-even point, gives you the margin of safety. It is how safe you are from making loss, or how sure you are of making a profit. So therefore, if we sell 30,000, we know that our break-even point from part D is 14,150. So therefore, if you sub 850 units before we would make a loss here, we have that margin of safety. And in sales revenue, we just multiply by the €20 per cap, and that's 317,000 euro. So we have this margin of safety. Our sales level was 44,000, so we have a greater margin of safety even than that. But the question asked us to do it at 30,000. But it is margin of safety is simply take away break-even point, and you have it in units, and then if you want it in revenue, you multiply by the sales price per unit. Question F says to prepare a marginal costing statement which includes the following. In fact, I'm just going to go back and read this question F because there's a little bit of detail in here. It says that we will reduce the selling price by €1. sales volume by 5%, so we're going to sell more of them, and everything else remains the same. So it's asking, what profit will we have if we sell a do that calculation by redoing our marginal costing statement, but with a new level of units and sales. So therefore, this is a marginal costing statement. It is 44,000. Oops, sorry, 44,000 multiplied by 5%, and then add on the 5%. Or if you wish, you could multiply by 1.05 on your calculator. But we're adding on 5% on top. So now we are saying that our sales are going to be the new level of units, which is 46,200, by €19. Our caps are, the variable cost remains the same, it says, which is still €10 per unit, but of course it's at a new level of units. So we can't do 44,000 by €10. It's now 46,200 by €10, which is this. And that gives you your contribution. And our fixed costs still remain the same. So when you take that away, your profit is 2,743. Would look and see, is that a good plan for the company or not? Well, actually, originally the company is making 298,74300. So the management accountant will say, no, we're not going to go with that. But until you do the and G in the question, well, we've already spoken a little bit about this. I've given you a bit of extra information here, actually. It says fixed costs are costs which remain the same regardless of how many products are produced. Rent or insurance would be examples of fixed costs. And I've just put in here that variable costs rise as the level of production also rises. And then I'm going to just give you one extra. This is a typical question in another in 2016. I think this was asked in 2014. It says calculate the level of units and sales revenue Shefflin needs to produce to achieve a profit of €400,000. Now, that's what we call a target profit. They tell you to get a profit of 400,000, what would we need to sell? Well, if you go back up here for a moment to the original, of course, we're a little bit off that. We have a profit of 298, almost 300,000, by selling 44,000 units. So logically, the answer to that extra 44,000 units, because we're obviously going to have to sell more caps if we want to yield more profit. And here we want another very similar to parts D, which is the break-even formula. Can I remind you of the break-even formula, which is fixed cost divided by CPU? Well, the target formula is almost the same. It is into the formula. So you add in the target according to question H, and you divide that by 10. Logical? Well, I think it is basically saying to yield an extra profit. If that answer was below 44,000, you would be checking your workings there because it wouldn't make sense. And then if we want that answer in sales revenue, you ignoring the fact that it was 19 briefly in question F, 1,083,000. And that's how you do